And it is recording, just so you know. See up on
Okay,
the
that's fine.
Jennifer?
Jennifer, we have no video.
Jennifer doesn't have her video on. You could chat with her.
Nah.
She just may not have it on yet. But her audio is working.
Now, what is this little symbol?
More. No, renew.
No. What's the view we want? Go from. Oh, good.
My video's not on.
I have my tall glass of water. Hopefully I won't spill it all over the place. And
Hello, hello, hello. The audio is working.
so are we going to keep our masks on or not socially distancing?
We're not 6 feet, so I guess.
We have to keep our masks on.
Pain in the ass. I do not like these things.
Welcome and call to order.
You should. Do you not?
Uh-oh.
Hello, 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 hello. Hello, 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 hello. You might need to.
I can't believe this is happening to me. we gonna have to keep our masks on? Oh, Lordy.
Caitlin, can you hear us now?
Yeah, I heard her say yes.
Oh, good. Don't know what I did, but I unplugged a bunch of things and plugged it back in.
That sounds like,
Dad would be so proud. They sent me off to school, spent all that money,
yeah,
and now I can unplug and plug things in, and sometimes they work.
I'm sure he'd be very proud of you.
He'd be very proud. Did we put up the agenda?
That's for the board, that's for you to get on the Board of Supervisors.
But I could put the agenda up.
What?
It's for 5 o'clock. Okay. That's fine.
What can I say?
I don't know.
Lack of interest.
Is Winter waiting or anybody like that? Is anybody else waiting? Is Ryan waiting? Ed? Ed, don't forget, you're controlling the Zoom.
I know.
Is anybody else in the Zoom wanting to get on? I'm checking with Winter.
That's for the installation, 102. I got material prices down to that.
Good, excellent.
Okay. Sounds
Yeah,
like a good,
I mean, that's fine.
sounds good. Sounds good.
And by the way, there are snacks and water and the little in the little kitchenette there. Yes, yours should be in the mailbox back there. You have your
Probably
fob
there.
to get in there?
Yeah, there,
Nancy,
there.
Nancy.
You got it.
Do you have your fob to get it? I can go get it for you. I'll go get it for you.
Well, you have a choice of monitors here. At least they're both working this time. Last time they didn't.
Suck it in.
I'm not leaving my
Everything
mask
catches
on.
my hearing aids.
We are too far away to worry about it.
Hello, test. Okay, Colleen Mullen.
Need a straw.
Hello, Colleen.
Hello. The governor opened up real estate business today.
Who did he?
Oh, did he?
Yep. So we can have transactions,
Could be some
although you
happiness
have
in
to
the
have transactions without lawyers because lawyers still can't work.
That doesn't make any sense.
family.
Not make any sense, huh?
Some happiness in your family.
Oh, and also he's going to allow for takeout cocktails. So I think that's next up, which also does not make sense to me. You can't drink and drive unless you take one out of a bar, and then you can drive with alcohol in your car,
Takeout
an open container.
She just,
Yeah, you can pick up your food and take a cocktail with you. And drink it.
Yeah, exactly.
but not in the car.
But what?
But not in the car?
Colleen,
Oh,
can
no,
you hear
you can
everybody?
take it in the car, but you're not allowed to drive under laws of operation of the road
Yep,
to
you
have an
can.
open container of alcohol in your car.
Good.
We bought our house, it's kind of like, we can't go inside, well, we're just gonna leave the package here, and you have to pick it up and sign it, and we pick it back up.
You went to closing though, right?
Yeah, back.
Good.
Colleen.
Good.
Coleen's there.
Oh, here we
Yeah.
go.
Yeah,
Where's Winter?
I hear you. Good.
it was weird, but we got it done, so.
Did you find
Today, actually, yeah,
it? Good.
yeah, so,
Good.
kind of out of the blue, but,
Oh, that's good news. I'm glad for you. That's
thank you. So a little less stressful.
This is the same place where I can remove.
Oh, no.
Get out. Wow.
I'm not to put it on us.
Wow. That's
My day.
very nice to hear.
Edward, Brian, Brenda. It's a regular rogues gallery,
I won't tell him you told me, okay.
except for you, Brenda, of course.
There's Winter.
He's in and out of wellness.
She's
Thank
taking a
you.
minute.
That's very nice.
Okay, she's in.
Okay, we almost ready?
Do we have everybody?
2 minutes?
Keep there.
Jennifer and Brian. We have. Looks like we have everybody.
So can everybody see
Well, I don't know
us?
about Ways and Means and
Can you see
Pat,
me?
whether there's more.
You see Ed Denton? Yes, Ed Denton.
Ed Denton.
Colleen, Bob both.
Who's controlling the screening and the muting and all that? You, Ed? Ed, are you, who's operating the Zoom?
Ed is operating the Zoom, once everybody's in.
So
Because
you're
it
gonna,
ties to the system itself.
so are you controlling muting and all that, jazz, Ed?
Yeah.
Yes?
Just so you know, I think we are recording just because of the stuff we usually. 'Cause of
So
the Zoom meeting.
are we recording the entire meeting via our website or?
No, just on the Zoom. We have it recorded.
Just on Zoom.
Just on Zoom.
So so Zoom is being recorded.
Yeah, Zoom's being
Does everybody
recorded.
know that? You can just nod your head
Yeah.
if you can hear me. Thank you. You're all muted right now, which is a lovely thing.
And Caitlin is in the tab room controlling your microphones and stuff like that. Okay.
Okay. Hi, Caitlin.
So this picture in the center is what is coming from the back room. So Caitlin, you need to move the cameras, get us, show us the front of the room. Whatever she picks in the back is what goes in there. There we go. There you go.
But our faces on the Zoom are depicted as we are, not
Yes.
as in regular Zooming.
Someone said something, I didn't hear it.
Okay, I think it's time to start.
Chiefs Radio.
So thank you, everybody, for being here or there. Thank you. I'm happy to hear that everybody's well and township is back in business. Real estate is now allowed in Pennsylvania, so we shall have transactions occurring and perhaps some real estate transfers adding to our, incoming income, hopefully. And we have a lot to cover, so we'll just get to it. Ken, you wanna take over at this point?
Actually, I'm going to do the first couple slides.
All right, I'm just
So-
following the agenda here.
Sure.
Yeah. So the information we provided previously talks about the coronavirus impact from mid-April. We shared pretty detailed memo with the board and with Ways and Means and staff. And at that time, we said we needed to take a pause in our hiring and capital program spending until midsummer while we gauge the impact. Reimbursement of the general fund for the new building loan. And the 2019 financial results were sent the beginning of May. We're 1.2 million better than forecasted overall. And that comprises the funds from the cell tower lease sale that we received of a little over 700,000 and just $500,000 improved in the fourth quarter revenue on capital deferrals.
Including.
The goal for today's meeting is to provide information on our township cash position, illustrate possible 2020 coronavirus financial impacts, present rationalized capital spending plan, reach agreement on short-term actions to be taken, such as the hiring freeze, 3-month watch and wait period, the rationalized capital spending plan, the reimbursement of the general fund for the new building, and the layout of the budget meeting schedule for the remainder of 2020, and identify items for inclusion for our June 16th budget work session. So those are our goals for today. I'm going to turn it over to Ed and Ken to walk us through the remainder of the presentation.
Okay, the next group of slides are meant to illustrate what the revenue, expense, and income is. Basically, we're going towards the use of cash. And we're doing that by looking first at what happened in 2019. And I don't want necessarily to ask you to take away the specifics of the numbers in this chart, but just have an impression that these are the spending numbers, not including capital spending, for 2019 by month. And lo and behold, they are relatively tightly bunched around that trend line, which I've just put up. They do trend up towards the end of the year, but with the exception of July, most of these are pretty well spaced, and they occur on a fairly regular basis. And that is largely because the biggest piece of those are salaries and benefits, which are paid out on a regular basis every 2 weeks throughout the year. If we add to that in 2019 the revenue, now those blue lines have gotten smaller, but the green lines that have been added show the revenue. And one of the things you can see from this is that in the first 3 months of the year, revenue is relatively light. It runs up in April and May, down a little bit again. The revenue is lumpy, and expense is more nearly linear. The combination of those two is what's on this last chart. It shows if the revenue exceeds expense, it puts a purple bar up. So here when we get to April, there's net income of about $500,000 and about $700,000 in the month of May. But the first 3 months consume cash. We bring in less than we spend. So we have to go into the year, we had to go into the year for 2019 with at least 1.37 million available to us to fund our operations during that period. Bear in mind, this is just the general fund, and it doesn't take into account other funds. This is also the fund that has the most action. This is $9 or $10 million of in and out during the course of the year. And you can see there's at least 5 red bars that stick down years, months when we consume cash. And there's actually another one out here. It's either May or June. It's just too small to show up on this scale. If you take the same patterning.
Can I interrupt real quick? Could you just explain what's the main cause for those red bars? It looks like we're not getting enough revenue in during that time. Is that just a seasonal pattern in tax revenue?
No, the revenue is largely tied to when we receive, in the case of April and May, when we receive the first tranche of EIT, but also real estate tax. Largely, most of the real estate tax comes in the first 2 quarters. Okay. And then EIT is much more spread out throughout the year. In fact, one of the reasons that the last bar, December, is so high is because EIT is also received in the first quarter of the following year, which is accounted back into the year. It's basically the 5th quarter. We don't receive it until February or March, but it is accounted back into the previous year because it represents activity from that year. So this is largely tied to the receipt of real estate taxes and EIT.
Thank you.
If you take this basic monthly pattern, and we don't know this for 2020, we're only in the month of May, but if you lay out the same patterns for the amounts that we put in the budget, you get a curve that looks very much like the previous. Here's 19, here's 20, Lo and behold, 20 has the same needs for cash. In fact, it has a little bit more. It says we need 1.4 million in cash in the first 3 quarters. Here's this little bar sticking down in June, and 2 more months where we have we consume more cash than we bring in. So this says we need to have a balance. This particular year, for the full year, we expected to not be very much in the way of net income. In the course of 2019, you'll see we had a net income of 1.2, but in 2020, we're showing it as only 0.2. We're consuming fund balance during the course of this year. So that illustrates the picture of the use of cash during the course of the year and why we need to have cash at the beginning of the year, basically to get us going through the 4th quarter. I'm now going to turn it over to Ken, who's going to turn this. Okay, Bob.
Ed, I think there's just 2 points I want to make. One is you show 1.44 in expense over revenue, but that is using budgeted income and expense. It is not your cash flow. You don't need that much for fund balance to cover that period of time, because you're getting earned income tax in January and February that you're booking back to the prior December. So you don't need $1 million. You really don't have a cash flow problem in January and February.
If you would hold your horses for a minute, we're about to go to the fund balance analysis, which deals precisely with that.
I'm talking cash flow and not fund balance. You're trying to make the point that you need cash in January and February.
Yes.
Which you do, but you're also getting a lot of the revenue that you booked to the prior December in January and February.
Yes, I understand all that.
Okay, so that $1,000,044
on a consistent basis so that all of the revenue that you see here for 2020 and all of the revenue you saw for 2019 includes that earned income tax and LST tax, includes the piece that was brought in the 5th quarter. So this has all been stated to be on the same basis. Your point is exactly right. We survive on the taxes that come in at that EIT that comes in for the prior year. That does help to build that balance.
But for you to make a statement that you need $1,000,004 in fund balance to cover January and February is not correct.
Pardon me?
I said the statement that you're making, you need 1.4 million in fund balance to cover expenses in the first 3 months is not correct, because you're not counting the revenue that you're collecting in January and February from the prior year.
That doesn't
So when
make,
you do a cash flow analysis,
I am counting it, and if you allow us to
I'm
go
gonna
to the
interrupt.
fund balance analysis, we would show you that.
Hey, you can't talk over one another, especially on Zoom. Somebody has to stop talking before the other one can start.
The next chart that comes up shows us that we do count that. If you could just hang on for a second. We know that it doesn't change the fact that we spend more in the first quarter than we bring in for the quarter for that year. That's an accurate statement. Anyway, let's move on to fund balance, and you'll see that we're actually in agreement. And for this, we're going to turn to Ken.
This chart represents the fund balance for this meeting of $4.3 million. But in the general fund, fund balance is your assets minus your liabilities equals your fund balance. Cash is one of those assets that's included in the fund balance. So as you can see by this chart, if you take the arrow, Ed, and point it towards, can you move the arrow over to, this is $1.7 million, which represents two components. It's the ending cash balance as of 12/31/19 of $763,000. And for this exercise, we took the EIT and LST money that we received in January and February of $907,000 and combined it for this exercise. So as you can see, it's $1.7 million of cash that's within the fund balance. Other components of the fund balance, $320,000, is a net of receivables and payables that are within the fund balance of the general fund. $825,000, which is within the fund balance of the general fund, represents the cell tower money, leftover payroll money to pay for taxes in January, and also there was a small leftover amount of money market fund of about $10,000, and also the leftover tab money as of 12/31/19 added up to about $64,000. The green part there represents CDs that we have currently with Pliget and multi-bank securities. Those CDs are about 6 CDs, and they add up to $1.5 million. Now, if you go to the end of April bar, you see that the cash has gone down as far as that balance is concerned. We still have our accounts receivables, we still have our cell tower and our payroll, and we still have our CDs at the end of April. But as you see, there's a deterioration of cash as far as between 1/1/20 and 4/30/20. Going back, going out further, if we have our budget, this is our budget for 2020. And as you can see at the end of the year, we would have $196,000 left in cash, and then we would have our receivables and our CDs and the one left over for, looks like.
And we did not have the cell tower.
We don't have the cell tower money in there. So as you can see, we have a down spiraling of our cash position as far as our fund balance is concerned. Because what we need is cash. And that's the problem that we have, is that we have a cash flow problem.
This is, okay.
So your possible 2020
Guess you
coronavirus.
have to explain.
Go ahead.
I'm having trouble understanding your cash flow problem. If you're ending the year with $2 million and you're keeping $1.5 million in investments.
Well, the investments would still be there at the end of the year, unless the.
But they're cash, so if you need them, your investments currently mature in June and July. If you need the cash, you don't reinvest them.
You're correct. If the situation is that if the supervisors wanted me to move the CDs from Pliget and multi-bank securities over to our general fund checking account, that's what I would do.
No, the point though is they mature, so they automatically go in, and you have to make a conscious decision to reinvest them.
That's correct.
So you do have the cash.
We would have cash from those CDs. That's correct.
Correct.
But the thing is that you have to also take in consideration risk, because if we're going to consume our investments, what are we going to have left over as far as if we have a
Broken bridge.
well, another hurricane, or we have a good snow winter,
Yeah.
or the pandemic comes back.
$1.5 million?
So we always have to assess risk as far as what we want to do with our reserves and things like that.
And it's been the policy of the board to maintain a healthy, unrestricted fund balance. And if we have to dig into our healthy, unrestricted fund balance, then that would make me very anxious. Because what if
There's no
there's,
question about that, Barb, but you still have cash. You still have money to pay your bills. You're trying to make the point that you have a cash flow issue, but you really do not.
I don't hear a cash flow issue. I hear an end balance issue. I think there's temporary cash flow issues because of how we collect money here, when taxes are paid and when EIT is collected. And we'll have some further anxiety regarding those revenues this year. So I would rather make sure we have a healthy, unrestricted cash fund balance as we have every year.
We're in uncharted territory. We're in the
Exactly.
middle of a pandemic.
Yeah.
We don't know what we're going to have on the other side when we come out of this.
Yeah, this doesn't end in 2020. The
No.
first quarter of 2021 is going to be really dicey for
Yeah.
all local municipalities.
Absolutely. Which I
And
think.
this
we-
196, even if everything went well, 196 is inadequate. I mean, one of the things that's come out of this is that we had a cash problem brewing before we had a pandemic, because this amount of money doesn't come anywhere near what that one is at the start of this year. And this includes all that fifth quarter revenue that is included to make that total. So this 196,000 assumes that the budget is met, which we're about to show you, we don't see there's any way it's going to be met.
So Ed, can you just clarify that? That does include the quarter 5 estimate for the EIT at the end there.
Yes.
Okay. If you could, maybe in the future graph, just mark that somewhere, because I was having questions about that being included in the beginning, but didn't look like it was marked at the end as being
The
included.
196 does inherently, revenue forecast includes all of EIT.
Right.
I don't have to do anything special to bring
But
it
what
back.
I'm getting at, when you look at the graph itself, the first column has the pound sign there, and it's saying in your footer that includes the Q5 as well, and it's not saying that at the end. So it's just a little confusing
Right.
from that
Well,
perspective.
it's
No,
just
they're
part of
on-
unrestricted
Those two are
cash.
on the same
Yeah, I
basis.
just want to make, I was having questions before he said that.
Well, first is unrestricted cash, which includes EIT.
Right.
So it's all,
So in the
That's why
first,
it's
in the
in
case
blue.
of the first bar, we had to add some things together to get to that. In the case of the second bar, we just kept our revenue forecast equal to budget, and that includes the fifth quarter revenue.
Okay.
So yes, this and this are on the same basis.
So I think going to what Barbara said, if we go to the next slide, what are those possible coronavirus scenarios that could impact us? EIT could be a reduction in a range of 5 to 10%, and we can show you past where we were, and I think we gave you some previous charts of where we were in 2008 to 10 and how we were impacted then. Real estate tax, possible reduction, but I think our biggest effect is going to come from the delay in the receipts, because that timing for the face value was pushed to July. Real estate transfer, the initial reductions possible. The state aid pensions that we receive in the fall, the state's obviously providing various funding for various coronavirus situations. We get a nice chunk of change from the state on that. Will we receive it? We don't know. We haven't heard we won't, but what happens if? The state liquid fuels aid, for 2020, we already received, but the question is, as Barbara brought up, what about 21? And what could happen there? I mean, obviously, we're seeing less people moving around, needing to buy gas, et cetera. So, that could be impacted. So let's go to the next chart and we'll talk about the unrestricted cash. Ken?
Yeah, as you can see by this chart that you had the beginning cash balance of $1.6 million. And like I said before, you had this deterioration of the cash at the end of April to a little over $1 million. And then you had, with our budget of $196,000 was left over from.
Same three you saw on the previous chart.
Right. The fourth one is that we received, more invoices for the building that we paid for, but also this takes into consideration the projected balance that that was a favorable balance as of 12/31/19. So it was a net gain of about $90,000 as far as ending with that projected balance of $283,000. But as you can see that, you have a deterioration as far as your cash is concerned throughout the year.
The solution, are you guys familiar with a tax and revenue anticipation note?
Yes.
That's your solution.
Well, you do a
This
train.
is not a new issue. I mean, I know that COVID-19 is new, but in 2008, you had the downturn in real estate. In the 1980s, school districts were faced with interest rates that were in 15 and 16%. And so the mortgage companies weren't turning over escrow accounts to school districts. So a tax anticipation note is the solution. It buys you 7 months to figure out what is going to happen. If you can prove you have a cash flow issue, it'll be cheap. It'll be the cheapest loan you can get, and you have until December 31st to pay it back. I mean, this situation cries out for a tax and revenue anticipation note if you really think you have a cash flow issue.
Well, that was one of the solutions I was going to offer to the board because, you can
Yeah.
have an anticipation note. But, when you receive your tax receipts, that's what you need to use to pay back the notes, from what I understand.
Correct, but it buys you till the end of the year to figure out what the situation is going to be. The other thing that's interesting is that the CARES Act talks about reimbursing local municipalities for expenses not anticipated. The interest that you pay on that, you could probably submit as an emergency expenditure and
That's a
get
good-
reimbursed for it.
Sure. When I first got here in 2010,
Mhm.
what the township had done at that time, after during the Great Recession, is that they did interfund borrowing because there was a due from the
Sure.
capital reserve fund at that time when I came here in 2010, and also there was a due from to the offsite fund, and so eventually those were paid back because usually on an interfund borrowing or loan, those things are supposed to be come to some resolution 6 to 9 months out after the interfund loan. So I understand what you're saying as far as the train is concerned, and using the CARES as far as the interest is concerned what we paid on that.
Okay, you want to take it on?
This is an interesting scenario that same three that Ed had come up with as far as this live change in the charts. So if we're projecting a 5 to 10% reduction in our earned income tax, so Ed, if you put in 10% reduction, you see that last bar at the end there sinks into a negative position. And, if we, our state aid pension, if we get, let's say, half of that, then the cash position, becomes even worse. So, but if you take the one scenario that we're talking about, the 1.5, 1.6 borrowing, Ed, if you put that in, it greatly improves the cash position as far as the end bar is concerned. So these are just some of the scenarios that we used to demonstrate today at this meeting.
But the weakness of this model is that it is one fund only. It is 1 year only. And all the stuff that we are talking about, some of the stuff we're talking about doing, we're going to talk about capital in a moment. Yes, we've deferred some capital programs, but to the extent that they have not gone away, they've simply moved to the right in time. So they've presented us a bubble next year and the year after. So in my head, I'm still dealing with a 5-year plan where I'm trying to maintain balances in the 5th year. And bottom line is we're pushing lumps around here. So we need to take this model, we need to expand it so it's multiple years, so it takes into account multiple funds and we can see the overall effect.
May I interrupt?
Please.
Can you please just describe and explain to the supervisors and anybody else on Zoom who may not be familiar with the conversation regarding reimbursing the general fund?
Reimbursing the general fund. We, several years ago, well, I'm not exactly sure what year, we borrowed $10 million to build this building.
2017.
We always thought the building cost was somewhere in the 11.5 to 12 million range. And lo and behold, it's come in right around in that range. But after we spent the $10 million, we elected at the advice of the Ways and Means Committee to hold off reimbursing the general fund. We would use the general fund in the short term to pay the difference and hold off going to get reimbursed, because we would do one large borrowing when it came time to, let's say, borrow money for a community center, borrow money for Pebble Ridge, Woodridge curbing, and then we would add this reimbursement into it. And then, of course, it assumed that the times were good times and that we weren't in the midst of some situation. Now, I'd say the situation is different, and combining the borrowing decision for community center, which isn't designed, and which the board has not yet decided to proceed on, with the curbing and the reimbursement, perhaps not the way to do it. Anything we've heard about what municipalities should be doing is to ensure and solidify their cash position in the short term. And so we're requesting that the reimbursement be pulled forward by 1 year to be executed. I mean, it basically was going to happen next year. But we're saying, let's do it now. Let's separate it off and separate it from the other decisions. So that's what the bottom line is.
And Joe, I guess that's my position, is that's probably, I think that's a bad decision. I think it's a bad option for the township. It's an expensive option for the township. The tax and revenue anticipation note, if you feel strongly that you have a cash flow problem, all that will shake out by September, October, and you'll know how serious the situation is. The Fed is talking about further actions, which would lower rates again. So waiting till the fall for that decision it makes a lot of sense. Borrowing now does not make sense. Just so that you have a 5-year model that doesn't show any deficits. In reality, the best solution, if you have a cash flow problem, is a tax and revenue anticipation note through the end of the year. It gives you 7 months to figure out exactly what the long-term solution should be. You can figure out your capital projects, you can figure out what you're going to do with the rec center, and you can figure out the best way to repay the $1.6 million.
Can we do both? Can we do a tax anticipation note as well as a separate borrowing?
You can, it'll just cost you a lot more money.
I don't
For
know.
no reason.
I'm asking if we can do that and what it would cost if we know. That way we have the cash flow that we won't have now or don't have now. And then we can also reimburse our general fund from the expense that we paid to it, which made sense at the time and made sense to, put off reimbursing when we borrowed more money for a community center or whatever. Doesn't make sense right now.
Barb, I guess, Barb, what I'm saying is this is giving you 7 months to figure that out. And if you can justify $1.6 million, do a tax anticipation note for $1.6 million. And if the rec center isn't in line and you're not going to do Pebble Ridge, Woodridge paving, then in November, you can still borrow your $1.6 million to reimburse if you need to. But doing it now doesn't.
Again, can you do both?
Do you have a comment on it?
I don't have a comment. I would have to find out about that, whether we can do.
This option?
Typically, long time ago, we did do tax anticipation notes. And we typically got them right at the end of the year, beginning of the year, for anticipation of waiting for the real estate revenue to
Right.
come in. It was before EIT money was even on the horizon. And then, yeah, we had paid it back by the end of the year. And one of the seminars with PSATs talked about that. And I think it's something we would look to, depending on where we are.
Well, it seems like I forget who made the point, I think it was Bob, that we could get reimbursed for the tax anticipation loan costs, should the governor decide that would be worthwhile. And we still could, with a separate borrowing, reimburse our general fund, which would keep our balance where we're comfortable. I think it's our responsibility to keep our balance up, and I'm not, to your point, waiting 7 months, Bob, the money is cheap now.
It's going to be cheaper, Barb.
Okay, maybe, but I know it's cheap now.
I also thought, it's Brenda, that we had talked about putting together a borrowing probably before the election at one point in time, kind of accelerating things or moving it forward. And I know that the community rec center may not be a piece of it, but if we know the amounts that we're going to borrow, the reimbursement as well as Pebble Hill, I'm not understanding either while we're wanting to borrow the money. I think it's at 2.1%. Isn't that what was stated?
Yes.
A TRAN has been discussed, is something that definitely should be looked at. And with all the money that's in the various funds, I just I don't see the need to borrow right now, 1.6.
We only have one general fund we're talking about,
Yeah.
not other funds.
Yeah.
We can only look to this one general fund of unreimbursed, the general fund. So that's the one we're talking about. We can't
Yeah,
add
the
in
other
all the
fund,
restricted funds.
The other funds are more or less restricted, and are in use. One of the ways we're dealing with capital programs is to, in fact, go use the offsite fund the way it could possibly be used. So we are tapping, we are proposing to tap the other funds, which are in fact restricted, and use them for the purposes that they're restricted for. That still leaves the general fund out in the open, but
Okay, so
gas to do the transfers this year.
When do you do the transfers, Ed? Is that the
Usually-
July anomaly?
Third quarter, Bob, if the funds are there.
Okay, so you can hold off on doing that transfer, and you still have plenty of money in the general fund.
Not only can we hold off, we have to.
Yeah.
We don't have the gas to do it at the moment.
well, what's the harm of holding off on doing the transfers? And that's the reason why I talk about, Barb, I understand we're talking about the operating fund, but the transfers that go into the other funds, obviously that's part of the cash flow that we're talking about. So I can't always separate and just focus on the one.
Agreed. That's why-
Only because you can't use those other funds in the overall fund balance. You can't, the way we govern is just to make sure that that general fund that's unrestricted is a healthy balance. And in doing so, I can't add in, I don't know if this is wrong or right, but I can't add in the restricted fund balances to make that other unrestricted fund balance healthier.
But is it healthier to have on the balance sheet a note payable of 1.6 million? And I don't want to get into accounting, a lot of accounting talk right now, but I think we can do some of that next week at the Ways and Means Committee so that we can keep moving forward.
Yeah, okay, good. I would like to know what Ed and Ken recommend, actually. I mean, you guys are the financial backbone of the, in addition to the Ways and Means as advisor group. What do you guys recommend we do? Stephanie, Ed, Ken?
I mean, our discussions, and we've been having this since the whole coronavirus started, was to reimburse the general fund the 1.6. That's been our discussion and our concern from the beginning. And I have to stress that to the board. Those are our concerns. I appreciate the position from the Ways and Means, but our recommendation to you would be to look to get that 1.6 in sooner, so that we can, in a sense, breathe a little easier.
We're just trying to put ourselves in a stronger cash position as far as that is concerned.
How is that different? How's that different than borrowing through a tran? You put yourself in the same cash position.
Right.
It doesn't make any sense not to do it. If you need $1.6 million, that's how you do it.
That's how you get it. I agree with that question. I guess I'm confused why you would do both. Why would you do the tran and go for a loan for an amount that you know you need now? I'm not sure I understand why you would want to do that immediately.
Because
this is Ryan. I think Bob is pretty clearly kind of stated where, his thoughts on this, and I'm understanding what he's saying, and you guys are saying the same things. You want a healthy cash position.
Mm-hmm.
If he's saying we can get there, is there a reason that you don't line up with how Bob's proposing to do it?
go ahead, Ken.
No, it's like I said, Ryan, that it's a good idea to go after the tran, because if that's an option that the board wants to take, all we're trying to do is just bring this to the board's attention as far as the pandemic, what lies in the future, and if there's a possible recession after the coronavirus is done. But that's all we're trying to do, is just bring this to the board's attention. So if it talks about going after a tax and anticipation note, then that would be fine as far as that is concerned.
What happens if we get the anticipated tax anticipation note of 1.6 million or whatever the number is,
Could we even
1.5 million, and then we have to pay it back in 7 months, and we're still $1.6 million in a deficit in our general fund?
Exactly.
Well, that's
typically
the problem.
That doesn't
because-
go away.
the
no,
1.6 we're looking at, we would pay off over, say, a 25-year period. The TANs are usually, you have to pay them by the end of the year.
Right.
And the idea is you're getting your cash flow.
They serve two different purposes.
Exactly.
One is just a cash
Thank you.
flow. The other one is a reimbursement.
The thing is that, and if I may just say that, we're down $200,000 on our EIT year to date versus last year. So, is there going to be a continuing deterioration as far as our EIT receipts are concerned?
I think so.
Yes.
We do think so.
Yes,
And
because
that's-
people like me are not allowed to earn any money.
And at the moment, in the 18901 zip code, 7.7% are unemployed.
But like I said, we're just trying to bring this to the board's attention and give options. And one of the options would be to do a tran, but we would have to pay that back with, the receipts that we get for the taxes are concerned.
What would the downside be if we got the tran and then when we watched how the township was doing financially, we saw we were going to come a little short? Then that's when we would get the additional loan.
Right.
So you would get tax anticipation note and then not have the receipts to pay it back, and then you would go out and get a loan? Is that what you're saying, Jennifer?
Yeah, I'm saying if it's a matter of it's still just us getting funding, the Tran, from what I understand, and I don't know a lot about it, is cheaper than getting a loan. We can get the Tran ahead of time, and if things aren't, if it's not sufficient for our needs, then we would get another loan.
Okay.
Correct.
Yeah.
And it gives you 6 or 7
Which
months
buys
to
time.
reevaluate things.
Right.
Right. The
Because you
wild
still
card-
have
I'm sorry, Bob. The
Pebble
wild card
Ridge
would
to
be-
deal with.
Yeah.
You have to make a decision what you're going to do with the rec center.
Not now.
the wild card would be is that if our EIT is off 10%.
And the EIT, if you look at the history, it's going to take all year to see what happens. The trip back to 2007, 8, and 9, that's what's on the up on the screen at the moment. The bar, this bar where the cursor is 2008. 2009's next to it, 2010. These are our actual EIT receipts in that time frame from our financial reports. And what you can see is that nothing happened to us in 2008. We were up a hair from the year previous, but in that particular period, we had a 2-year dip followed by a 6% dip, followed by a further 5% dip in the second year until it finally recovered up 15% in the third year. So we have, I think, plenty of reason to anticipate EIT will be off this year and probably next year. And it is our single largest source of revenue for the general fund.
It represents
for anything.
Represents 66%.
Wow.
But what's the dollar number?
It's
You
4.4
anticipate
billion
being down.
So it's a little over a third by itself, but it plus real estate taxes plus real estate transfer, all of those taken together are.
So if you're off $500,000, it's what you could be.
Bob, you have to repeat your question because he's talking. and we
I'm
can't-
wondering what the maximum they're talking about. Is it $500,000 that we could be short in revenue?
Well, the assumption that you saw in the model was a 10% assumption, which was $440,000 in year one.
Okay.
So year two, if it's similar, another 440 or so, you could get an $800,000 miss in EIT over the next 2 years, I would think, without half trying. And that's the single biggest problem. Real estate taxes, historically, this is the same chart, but for real estate taxes. And what you'll see is that there's not much happened with real estate taxes, even though houses went into foreclosure and that sort of thing. I gather the banks paid the taxes, so the tax revenue must have stayed in. So we think the biggest problem, and the spike that you see up here where it went up is we raised millage at that point in time. So that's not material. We think the biggest problem with real estate taxes is so we think we'll receive things on a different timing basis, but not necessarily a different amount basis. And as far as real estate transfer tax, it's all over the map. I can't really make anything out of that relative to 2008, 9, and 10. These are all plotted exactly the same way. So you can see what the year-to-year change would be. So it's really the focus on EIT is, I think, is the big deal for us.
Well, already we've lost 3 months of income, basically. Anyone in the private sector has lost 3 months of income, which is taxed not for this year, it's for next year. So the first quarter of next year, or at least, a third of the tax issue next year, or excuse me, 25% of tax is already lost for EIT.
Let me show you one other thing I hadn't showed you. This is This is the last 5 years of EIT revenue. And the only point I'm trying to make in this chart, if you look at these colors, you see that EIT has a fair amount, like 38% of it is received in the first and second quarter. And then it's pretty even all the way through. And there's a big chunk that comes in the fifth quarter. So EIT is spread out throughout the year, unlike real estate tax, where you can see that we're just about at 85% by the time we get to the end of the second quarter for standard real estate timing. So we'll know, I wouldn't guess by August, where we are for real estate tax.
Here's a question. The basic question is, assuming we can manage the income coming in at various stages or not, the inconsistency of the income coming in why do you still encourage or suggest or recommend a borrowing of 1.6, assuming we can manage the income coming in?
I would say mainly because we think that the EIT problem will be a multi-year problem. So even if we know it, it's not liable to be good. And number two, we can see that we were pretty shy on cash to start with. I mean, if we made budget and we got to ourselves around $300,000 in cash, including the fifth quarter input from EIT, we were already in trouble. We already were going to have to do something to bolster our cash balances. So in fact, us lending $1.6 million to the new building project, well, as fortuitous as it was at the time, has now sort of come out from under the rocks. And so I still think we need to fix it.
And not waiting till later in the year as, I guess Brenda recommended.
I don't see any particular benefit of that, no. I recognize it could be, the loan could be a little cheaper, I guess that's right, but no, I don't see there's any advantage, at least from an operating point of view, in waiting.
You know, Barb, I have to tell you that I see no advantage of borrowing $1.6 million now to repay yourself, pay 2.1% interest on it or whatever the number is, because your revenue is going to be short. So you're borrowing money over 10 years to pay a revenue shortfall. That's not what you do. A tax anticipation note fixes the problem for you until you know for sure in October, November, whatever the timing may be. Borrowing $1.6 million now to reimburse yourself doesn't make any sense at all financially.
No.
What I hear is that we're not going to know in November what the implication of the EIT deficit will be this year, next year, and the year following. We don't.
But even if you haven't, if you don't know, then you can borrow your $1.6 million then. Borrowing it now doesn't make any sense. And the Ways and Means Committee was very unanimous in that.
And one of the things about EIT, and I really appreciate all the work at looking back at 2008, 2009, because I was on the Ways and Means, and I think Ed was at the same time. The unemployment trends and how it hit everybody is different so far than what we're experiencing. I know, Barb, some professionals aren't being paid, and we have unemployment of 7.5, as Stephanie shared. But there are a lot of people that are still being paid, teachers, people that are working with school districts in general. I know executives. And it would be nice to have Keystone evaluate, if they can, give us some information about who's being hardest hit, because that will impact whether it will be really a full 10% that's reduced. In other words, what I'm trying to say, and going on too long, is that it may be a little bit early to jump to the conclusion that EIT is going to be down $440,000 for the year. And doing the TRAN, again, would buy time. We could do more investigation with Keystone. and watch when the real estate money comes in. And then tee up for next year, because 2020 real estate taxes may be a totally different question in it, as well as EIT.
Well, I see here, and I hope it gets resolved, a dispute, a difference of opinion between the Ways and Means and our Finance Department. So I think we need some reconciliation on that. Perhaps we can think about this and look a little bit further into it. I see the administration's position very clearly, because I would like to have a healthy fund balance that is not part of the restricted and calculations. And I see a tax anticipation note is something that is just short-term, that it handles the uncertainty of when tax revenue is coming in. And that is all that is. It still doesn't make us have a healthy, unrestricted cash fund balance, which is what I'm going for. So that's the difference of opinion. It seems to me Ways and Means doesn't think to the same extent that we need a healthy, unrestricted fund balance. It sounds like that is not their focus.
I would disagree. I think we have that same goal in mind. It's just a matter of how do we go about funding it that's prudent as much as possible. And I think it makes sense to use a temporary bridge in Tran, discuss other capital spending that needs to occur, like the curbing and other projects, and come to that conclusion as planned towards the end of this year in terms of the municipal borrowing. I think that's where Ways and Means position is, but I think we all agree we need the healthy unrestricted fund balance.
Yeah, I don't know if that anticipated fund, that anticipated loan would be sufficient to fund the curbing and the other projects that are now pending.
Barbara, the intent is not for that to do that. You would still need to do a borrowing at some point in time. You have plenty of money currently to do the curbing if you want to. That's another discussion, but the tax anticipation note takes you through the concern that your administration has raised about cash flow.
Right. I'd like to hear from the other supervisors. Nancy, have an opinion?
I'm listening and learning. I would say I'm probably more conservative, and I don't love the idea of borrowing right now. I like the idea of waiting and seeing how this plays out. I think there's going to be a push of money because they want to make sure the economy is strong. I don't know enough if there's a ratio that we need to show. If there's an advantage of how how we should look, then I would want to know that. Otherwise, I sort of lean towards waiting on the loan. That's where I'm at.
The rule of thumb, Ken will correct me if I'm wrong, I think we're supposed to have 15% in general fund unrestricted above our budget. And some good practices even say that we should have 3 months equivalent of operating costs in the balance of an unrestricted account.
That's correct.
So at this point, we don't have either.
Barbara, I think that you do. You have $1.5 million in investments. That's unrestricted fund balance. So you have 15% of your budget in investments. So it's not a matter of maintaining a proper fund balance. You have that. See the green?
Yeah, I do. I just
You can use that for anything you want. Whatever emergency you have, you can use that money for. So, and that's about 15% of your budget, plus the other unrestricted cash. I think this slide is misleading because the green and the top blue should be together. That really is cash that you have in your pocket that you can spend for any emergency.
Right.
And when we do, what happens then to our balance, our bottom line? If we have to draw on that 1.5 million, what happens to our bottom line? Regardless of whether
What happens if it's 10 million and you draw it down? Your fund balance policy that you sent to us talks about 15%. You have it. You have it right there at the end of the budget. I don't know what else to say.
And Dan? You have any?
Yeah, my main question, I think it kind of follows Nancy's point a bit. I don't know much about this TRAN fund. It's the first time I'm hearing about it today. What is our timeline looking like for having to make a decision on borrowing money? Is there a timeline on the TRAN fund, like when we have to have that, the trigger pulled on that? Basically what I'm getting at is when do we have to make these decisions? How long can we wait to see how it plays out in Harrisburg and Washington to see if there'll be programs that can help local governments?
Well, we believe we need to get through the summer, into the summer, to really gauge what's happening to us. We're not saying we know at this point what it is. I'm not even certain by the time we get to August that we're going to have any really good indication, because EIT is certainly way out in front of us in that regard. We would still be waiting for a good 30 to 40% of the revenue from September on under normal circumstances. So yeah, we could compute, assuming what we had year to date was reasonable, we could take a guess at it. But the whole thing is tied to so many other factors outside of here that I think we're going into a period of fair amount of uncertainty. And I think it's you could argue 12 ways from Sunday, but I certainly could make an argument that says that although we have a jobs cut back at this point based on the initial surge of coronavirus, what happens when businesses go back to work, can't run at full capacity, find all of a sudden that they with social distancing or whatever, that they have to operate at 60, 70% of capacity. Now, I'm making this up, but when they run at 70% of capacity, it isn't going to be low-paying jobs that disappear. It's going to be businesses need to restructure. So we could see another whole wave of layoffs that deal with the kind of administrative staff that live in our area, hit harder than the frontline workers. I think it's plausible. It could be a W-shaped recovery with a bunch of punches through it. We don't know. And so we need to be prepared for, to some extent, a worst case.
If I'm following your thinking then a bit, then this 1.6 isn't just to get us healthy for this year. It'll make us healthier in the next 2 to 3 years,
Right.
assuming there's a longer lasting recession.
Right.
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 And the TRAN would not be able to do that scenario because it would only cover us for this year.
Or next year.
Next year, yeah, sorry, correct.
And
How
that's
about Ryan and Jen? Do you guys want to weigh in on this?
I mean,
Sorry.
go
Go
ahead.
So I actually had some questions. So we're looking at doing a borrowing anyway for other projects potentially. So one of the thoughts is we're looking at the TRAN because it might be less expensive basically to get this type of loan, this note. It's less expensive than a loan. But would it offset some of the cost knowing that we were going to bundle it with the other projects, the loan money with other projects? I mean, there's some cost that's going to be that won't be added on to the borrowing because we're just bundling them all together.
Yeah, you know,
I'm not sure of the question.
I've done a number of tax anticipation notes.
Can you wait, let Ed answer the question. Can you repeat your question, Jen, to Ed?
Okay, so I'll try and be a little bit more clear with this. We're talking about we're using a TRAN as a way to give ourselves some more cash in our funds. And the reason why loans, from what I understand, a loan would be a less beneficial choice is because it would cost us more. Getting the loan and the interest rate would be higher than a TRAN. But when we're looking at the extra costs, are we actually looking at if we bundle it with other things, if we are going to get a loan, is that going to end up would that mitigate some of the cost to borrowing with a note? I mean, getting a loan? Sorry.
Just so there's no misunderstanding, we were already going to pay ourselves back in 2021. There was already going to be a borrowing at whatever the rates were for that borrowing. So it seems to me the question, and there was debt service put into the budget plan to cover all of that. I mean, but the loan had three components. It had the repayment that we're talking about now, had the community center, and had a piece of curbing for Pebble Ridge, Woodridge.
Right.
Now we're talking about taking this one piece and pulling it earlier, and we're talking about so it would run for the same length of time, but probably at a different repayment rate than what would happen if we did a bond issue for a bond borrowing for as was originally anticipated. I'm not sure what the difference would be. Percent, 0.75%, something like that.
Yeah, something like that, sure.
I think you're not talking apples and apples though, Ed, because the $1.6 million, you were talking for a 10-year period of time. The other loans which would go in through a bond issue would be over a 25-year period of time.
No, Bob, we were talking about borrowing all of it for 25 years.
Correct. But the loan that's proposed now, the bank loan, is only for 10 years.
No, the bank loan's for 25 years.
25 years?
Yes, and there would be a recalibration.
I'm sorry, then I misread that. That's my mistake.
No, Bob, there'd be a recalibration, as you well know, at the 10th year.
The interest rate recalculation.
Did your question get answered, Jen?
Yeah, I was also, I also was curious with the TRAN. This is something that we usually do, just kind of a bridge loan kind of thing, right? So you anticipate a shortfall. You need to have a little bit more cash in your fund. So what's to keep us from doing that for more than 1 year? Would we be able to have one this year issued and then another one next year issued if we needed to?
Yeah, we can check on if we can still do a TAN in 2020, but
That's a possibility, in
It's a
other words.
possibility for 21, for 22. The idea is get it, and when your real estate money comes in, you have the money to replace what you borrowed. So, you know, like I said, we did a long time ago. And just so everyone knows, just for a level of comfort, we're participating with the Bucks County Consortium of Municipalities in an economic study that the consortium's doing for the members in Bucks County, and looking at, you know, various scenarios and impacts from an economic standpoint. So hopefully we'll have that information soon-ish.
Okay, I have two more points. The one was for the loan costs, the cost of borrowing. If we bundle it all into that, can we still use that for the CARES reimbursement for the costs related to COVID if it's bundled, or does it have to be distinct? Do we know?
I think that would depend on the parameters set up by the federal government as far as what we could get reimbursed for as far as the CARES is concerned.
Right, but we were saying that the cost for the TRAN would be, may be able to be reimbursed through the CARES Act. I didn't know if that was the same true for the loan.
The purpose of the TRAN is to get you through the fiscal year because of loss of revenues from COVID-19. If you borrow for the building, that's not going to be reimbursed. That has nothing to do with COVID-19.
Right.
Right, but if part of our borrowing is
your question, go ahead.
But if part of the borrowing is in anticipation of having a shortfall in our general fund to cover the loss in the EIT, that's still not, that still wouldn't qualify for the CARES, the costs related.
I don't see that would. but
The way a TRAN works is you actually prepare a document that shows you're going to have a cash flow issue, as Ed did with January, February, March. I don't see how you would justify it. Borrowing 25 years, $1.6 million to reimburse the township building cost. I don't know. I don't know how it would happen.
Okay. And my last question is, we were looking at the jobs in the township. Stephanie and I had a conversation, and Ken and I had a conversation about the jobs in the township, and it looked like a lot of them were related to the hospital, the school district. So I'm curious to see how that's going to play out in the next couple months as far as unemployment rates go, because it sounds like the township is not in the worst shape that it could be as far as our EIT revenue. Of course, it's not in great shape because of COVID, but that gave me a little bit of comfort knowing that those are our larger employers. Stephanie, do you know that 7.7% was that from last month, the unemployment?
It's through April 30th.
Okay. All right. And that was my last question. Thanks.
Ryan?
I don't have any questions at this point that haven't been answered right now.
Thanks, Ryan. Okay, anything following up?
I think we want to quickly go over you want to do the capital thing?
Yeah.
Do that, and then we still have pension, the ed.
Okay.
I would very quickly give you a flavor for what we had done from a capital point of view. This is see if I can move this there. This is like a bridge analysis. So the line at the top is the amount of dollars that we had in any particular fund budgeted to be spent on capital programs during the course of 2020. And these are the names of the funds: General Fund, Parks Fund, so forth and so on. Over on the right side are two funds that are used to do road works, and then there's a brown column, which is just the sum of the two, because we kind of use them both to do the same thing. It's just for convenience. Anyway, at the bottom of the chart is where we've ended up as we've reviewed those programs. You may remember we sent you some pretty colored charts. They were green, yellow, and a beautiful pink color because we couldn't make them red. Anyway, the red ones were programs that we thought we should defer. The yellow ones were ones we wanted to discuss, and the green ones were ones we thought we should proceed on. We've taken yet another cut at it from the perspective of not trying to use the funds we have in other special purpose funds to not only to defer some programs, but also to find other ways to pay for them. So these first three entries, bridges and stream crossings, the crosswalk at Pebble Ridge, and the Bridgepoint Park Wall, which we had budgeted at $15,000, but which has now turned out to be a big bulging wall problem, which needs to be fixed in order that the road doesn't get destroyed. We've moved them, all three of those, into state liquid fuels, or we could move them into the roads maintenance tax one, but one way or another, we're not taking them, we're proposing not to take them out of capital reserve. By not taking them out of capital reserve, we don't have to do a transfer to pay for them, and that saves money in the general fund. Down below, a series of deferred programs. Green Light Go is an Arley grant, which isn't going to happen.
Green Light Go. Green Light Go. Green Light Go.
Green Light Go, sorry. Right.
Cannot hear you.
It's moved out in time. Swamp and Easton Road, the same sort of thing. They all came out of capital reserve and are deferred to the future. Traffic calming, the same thing. Prefab storage and building, you're probably all tired of hearing about this, but there's a new thought about how to do this, and that would be deferred to the right in time. 2 parking lots that don't have to be seal coated and fencing worked on this year. So we moved them out to the right. They came out of the Parks Fund, which is another one that we have our eye on. And then the big one, park lighting, which we have budgeted for $235,000. We believe we could make the case that it's something that we should do, but pay for it out of the offsite fund, which is for amenities, so forth and so on, as opposed to paying for it. And I believe Dave has got a quote that he's actually brought this in for slightly less money. Lastly, we had a 2-year program to upgrade our PCs and software to Windows 10 and Office 2019. We agreed, after talking about it, to do a certain amount of that this year, but less, and move 22,000 more of it into the following year. And a lot of what we're focused on at this point, because of the pandemic, is making sure people can work remotely. So that's another overlay that kind of got in this. Bottom line of this is that we took close to $1 million worth of capital reserve programs and moved them either out in time or into other funds. So that says we would still have to do a $500,000 transfer to, well, we have to do at least a 200, because we started the year with 272. So we would need at least another 250, 300 to make it there. Parks, we thought we would have to transfer 225, but we've managed to pull that down by a fair amount also. So in both cases, we found ways to reduce the transfers out of the general fund to support capital programs in parks and capital reserve. It's not finished. It's something we're still working on, but it at least gives you an idea of where we're headed.
Can we move now on to pension?
Yes.
Thank you. Sorry, pension.
What?
Go ahead. Sorry, pension guys, that we didn't allow enough time for you, or hopefully we have enough time for you.
Do we have enough time?
You prepared a wonderful presentation that we all read with in a PowerPoint format on paper. So I think maybe if you can just hit the highlights of your recommendation, that would be helpful. And then if we have any questions, we
If you
can
tell
ask.
me where you want to go in this, I'll move this.
Okay,
Right.
so go ahead. We ready?
Yep,
I'm ready.
you
All
go.
right, let's go to slide 3. All right, slide 3 is the 2020 objectives. So somebody can mute. Is the 2020 objectives that the Pension Advisory Committee developed during our first meeting of this year. I think it's pretty self-explanatory. We're going to be discussing objective 1, 4, and 6. Let's move to the next slide. All right, the graph on slide 4 shows pension liabilities and assets since 1997. The graph highlights the fact that the pension assets and liabilities grow each year and that the pensions have been underfunded since 2003. For those of you who are not accountants, the pension assets represent the dollar amount set aside to pay for current and future employee pensions, i.e. that's the pension plan's investment portfolio. The liabilities represent the retirement benefits owed to vested employees at the end of each year. Next slide. Slide 5 shows a pension plan surplus and deficit by year since 1997. As you can see, despite the strong stock market performance since the global financial crisis in 2007, 2008, the township's pension plan deficit continues on a downward trend. Next slide. As we all know, because of the disruptions caused by the coronavirus pandemic, stocks took a hit in the first quarter of this year. As a result, the township's pension plan investment portfolio
dropped about 18%. The Pension Advisory Committee estimates that the pension deficit at the end of March increased to $11 million, assuming a 6% discount rate, which translates into a funding percentage of 63%. However, while markets have partially rebounded since March 31st, there still remains a lot of uncertainty concerning where markets are going over the next couple of months and years. Next slide. Can somebody go on mute, please? Thank you. All right, is everyone mute? All right, in slide 7, we provide a top-level overview of the municipal pension accounting. Each year, township employees earn service time towards their pension. The township's actuary estimates the annual cost of this service time by using actuarial formulas tied to the pension plan's design, participant demographics, years of service, etc. Two outputs from these calculations include the minimum municipal obligation, or MMO, and the total pension liability at year end. The MMO is the estimated current year cost of employee pensions. The discount rate is one of the key assumptions used in the calculation of the MMO and total pension liability. Generally speaking, can somebody go on mute, please? Generally speaking, if the discount rate assumption, somebody go on, please go on mute. We got feedback. The discount rate is one of the key assumptions used in the calculation of the MMO and total liability. Generally speaking, if the discount rate assumption is too low, the township will overfund the pension plan. If the discount rate assumption is too high, the township will underfund the pension plans. Next slide. In slide 8, we try to illustrate what happens to the pension plan when the investment returns are above or below the assumed discount rate. As you can see, in 2017 and 19, the pension plan's investment returns exceeded the discount rate and the pension deficit went down. That's good news. This is what we want to see happen on average over time. Unfortunately, this only happened in 2 of the last 6 years. Next slide. Why do the township's pension plans have a deficit? The simple answer is the township did not adjust the discount rate used to calculate the MMO and the total pension liability as market conditions changed. If the discount rate had been adjusted, the calculated MMO payments over the last several years would have been higher, and the pension plans would be closer to fully funded. Unfortunately, the discount rate was not lowered to a more realistic rate, so the township has effectively been making partial pension payments for the past 10 to 12 years. Next slide. Why is a pension deficit a problem? The best analogy that we've been able to come up with is that this is similar to what happens when you or I do not fully pay our credit card at the end of the month, i.e. we have to pay interest on the outstanding balance. Right now, the interest cost on the township's average $8 million pension deficit is approximately $500,000 per year. And this yearly interest cost will continue to go up if the pension deficit increases. In addition, within the next 10 years, the number of non-uniform employees collecting pension benefits is going to exceed the number of plan members contributing into the plan. This will put a further strain on the pension plan's financial condition. Third, a growing pension deficit could negatively impact the township's bond rating, resulting in higher borrowing costs. And fourth, the underfunding of the pension plan penalizes current and future taxpayers and employees who will have to eventually pay this bill. Next slide. All right, now we move to the recommended target discount rate. Next slide. In order to decide what the appropriate discount rate should be used, the township needs to evaluate what historic returns have been and what experts are forecasting about future returns. Unfortunately, there is limited information available on the township's historic investment returns. The data on the left-hand side of slide 12 is from Vanguard. It shows historic investment returns for various portfolios. The township's current portfolio is invested 65% in stocks and 35% in bonds. Based on the Vanguard table, a 65-35 portfolio had an average return of 7.55% through 2012. Note this is slightly below the 8% discount rate that the township has been using for most of the past 25 years. The right-hand side of the slide shows the township's investment returns for the past 6 years. As you can see, the average return is 6%, which again is below the township's current discount rate of 7.75%. Next slide. The Pension Advisory Committee recently asked Deb Breedy and Jim Kennedy to provide their recommendations of what discount rate the township should use. Slide 13 summarizes their recommendations. We included a copy of Deb Breedy's recommendation letter to the township on slide 19. You all have that. As you can see, Deb Breedy, Jim Kennedy, and the Pension Advisory Committee unanimously recommend that the township's discount rate should be 6%. At the bottom of the slide, we included a list of some of the events that could impact future investment returns and the discount rate over the next 10 years. Next slide. On slide 14, the Pension Advisory Committee recommends that the township lower the discount rate by 0.5% every other year until it reaches the target rate of 6%. The committee also recommends that the township continue making, quote, extra mortgage payments of approximately $160,000 in the off years. Next slide. Slide 15 shows how much the 2020 MMO payments would increase at different discount rates. For example, lowering the discount rate 0.5% from 7.75% to 7.25% increases the estimated MMO payments by approximately $280,000. Next slide. In summary, the township's employee pensions have been underfunded since 2003. The average pension deficit over the past 6 years is over $8 million, assuming a 6% discount rate. The annual interest costs associated with the pension deficit is approximately $500,000 per year. The root cause of the underfunding is the outdated discount rate assumption. Breedy, Kennedy, and the Pension Advisory Committee recommend that the township establish a target rate of 6%. The Pension Advisory Committee also recommends that the township gradually lower the discount rate by 0.5% every other year over the next 10 years until it reaches the target discount rate. PAC also recommends that the township continue making the extra mortgage payments. If the above actions are taken in approximately 10 years, both pension plans should be close to fully funded, and the annual credit card interest cost of approximately $500,000 should be eliminated. Next slide.
Thank you. Do you have an idea of what the extra mortgage payment is that you're recommending?
It's on. If you go back, go back another one. So basically, we're basically saying $160,000. So basically, as the township lowers the discount rate, the MMO will go up 0.5%. If you sorry, if you go back one more slide.
Yeah, got it. Understand.
Yeah, all right. So basically, it's $280,000 plus every other year. So basically, what we're recommending is that the township effectively decrease the discount rate 0.25% every year. In those off years, it would make the extra mortgage payment, which would be equivalent to the 0.25%.
Okay, thank you. Got it. Thank you.
Yep. Any other questions?
I want to say something, but I don't want it to sound like, I don't want it to sound what it's going to turn out to sound like. I wish that Breedy and Kennedy and his predecessor had advised us years ago to lower our discount rate instead of like waiting till now to do that. Because we took our
yeah, go ahead. Yeah, well, actually, I went back in the pension minutes back to 2012. And in 2014, Breedy actually brought up the subject of lowering the discount rate. Unfortunately, and I've attended some of the meetings, I've attended several meetings over the last 3 years, is I don't think they were, well, yeah, in my opinion, they weren't as forceful as they should have been. And that's why we're being as direct as possible. This is really something that they should have been more direct on. I agree with that.
Thank you, Ed. Any questions from anybody? Jen, Ryan?
Excellent presentation. Thank you.
Nancy has weighed in. Dan?
No, Mr. Denton was kind enough to give me a call earlier last week to go over the slides, so.
Okay, then. And anybody have a question here from the finance department? Okay.
No.
Thank you, Ed. Really appreciate your work here.
You're welcome.
All right, is there any other business here?
I think we have our you have our slide with the conclusions, and I think, when all of this started, we said we need to take a pause. We need to kind of evaluate everything. And we want to make sure that everybody's on the same page going forward, and understanding what we're going to be facing. I think one of the things that's very important is we always have a lot of budget meetings through the process, but we're adding more. Besides the regular budget workshop in June, we're going to be adding the July meeting. So basically your July and August meetings, we're adding time to do a supervisor's pandemic finance update. And then you have the rest of the schedule for our regular budget work sessions as we begin to plan for 2021.
All right, thank
So
you.
we want to keep you informed. If you have questions, let us know. We'll be working with Ways and Means. But, we're operating under a state of emergency, and obviously any of the changes that were suggested in terms of capital and stuff, those will all have to be reviewed by the board at some point with a resolution. I talked to our solicitor today in terms of process on that.
Okay,
Okay?
thank you. I just want to say one final thought. If we were presented with the $1.6 million bill today to close out our building obligations, if we were presented with that today, we wouldn't be paying it. We would have been borrowing it. We okayed that expenditure in the go-go times, and we shouldn't have, because we didn't anticipate this, but who could have? Now we're here. I think it's really prudent of us to reimburse that money. We should, if, like I said, if we were presented with that bill today, we would borrow that money to pay it. But we borrowed it from our taxpayer base, and that should be reimbursed. That's my last thought. Nobody gets to say anything anymore. Okay, we're adjourned. Thank you.
Thank you.
Bye, everybody.